Hello everyone. So today we'll be looking at bank reconciliation statement. It is a chapter a lot of students have a lot of difficulty with. But the funny thing is, if you understand the logic behind it, it is extremely easy. And there are actually two methods. There might be more methods, but as far as I know, there are two methods to look at bank reconciliation statement. One is called the hand method. The other is arrows method. Now, hand method, you adjust the position of your hands, and based on the position, you decide whether to add an item or subtract an item. And in the arrows method, you draw upward facing or downward facing arrows, and uh, depending on where the arrows are pointed towards, you decide whether to add or subtract an item. So before we get into bank reconciliation statement, the actual problems or sums, I think we should have a look at why we do bank reconciliation statement in the first place. What is the logic behind bank reconciliation statement? Now, uh, so we all know in a previous chapter, so when we teach it in school or college, we first teach journal. We teach the basics, then we go to journal, then we come to ledger, then we have cash book, and only after that will we be learning bank reconciliation. So starting off with cash book, it is an account or a ledger, or even a cash book is both a journal and a ledger, right? So, uh, in a cash book, the business will keep the record of all the transactions which take place either through cash or through their bank, right? So, a cash book, we have looked at double column cash book or a triple column cash book where there would be a bank column, there would be a cash column, and then there would be a discount column, right? So, all the transactions will be recorded which are done through payment of cash or receipt or cash, it would be recorded in a cash book. Now, the bank will also have a book known as a passbook. It's either known as a bank statement or a bank passbook. It is a copy of a bank account as shown by the bank records. So if a business is maintaining the business's um, transactions in a cash book, the bank will maintain the transactions that took place through the business's bank account in a passbook. So ideally, it should be the same because meaning the bank column of the business's cash book and the bank passbook total or the balance should tally because it's the same. But in practice, this is not the case. So I have highlighted two lines over here. Business organizations keep a record of their cash and bank transactions in a cash book. Yes. It is usual to check its detail with the records of the firm's bank transactions as recorded by the bank, right? Now, the amount of balance shown in the amount of balance shown in the passbook or the bank statement must tally with the balance as shown in the cash book, ideally, right? Because we are talking about the same transaction. If you pay your employees' salary through a bank transfer, in your bank column, in your cash book, you're going to deduct that amount, and in your bank account, the passbook will also show a deduction. Money has gone out of business, right? But in practice, they are usually found to be different. So, in practice, this might not be the case, right? So, I will highlight it with a different color. In practice, these are usually found to be different. Uh, so, we have to understand the difference for the same. So if deposits exceed withdrawals, it shows a credit balance. And if withdrawals exceed deposits, it shows a debit balance. It shows an overdraft, right? Now we'll get into the details about this. But first we need to understand why we need reconciliation and what do you mean by reconciliation? Reconciliation or BRS, bank reconciliation statement, it ideally means that the bank column in your cash book and your bank's passbook should tally. right? We have established that. Now, this will not tally for various reasons, right? In practice. Now we need to tally or reconcile the differences between these two balances, right? So what we usually do, if you look at the format given uh, in the book I am following is the NCRT textbook, rationalized as per 2024-25. So we start with balance as per cash book or balance as per um, passbook. Any one balance, we start the whole calculation with one balance. We add and subtract certain items, and then we reach the other balance. So in some questions, um, both the balance as per cash book and balance as per passbook will be given, and the various items will be given. You just need to start from one point and reach the other point, and you can cross check your answer, you can verify your answer. But if that's not the case, you will be given one balance, you start with that one balance, you correctly identify what all items you need to add or subtract, and then you reach the other balance, and that's it. So we are just making sure that the balances are not the differences are not due to any error committed by either the bank or the business, but due to timing differences. Okay, we will look at that in detail. We'll come back to the format, but right now we will, this is the specimen of bank statement, which was not there in the previous textbooks. This is only, I think this is a new addition to the 2024-25 textbook. Now, reconciliation of cash book and the bank passbook balances amounts to an explanation of differences between them. Now, it can either be errors or can be timing differences. We will be looking at timing differences right now. Now, we need to understand the concept. There are various factors affecting time, right? So what you mean by time is, how do you reconcile? Basically, you need a bank statement or a passbook copy from the bank. Then you take your cash book balance, the latest cash book balance, the the copy of bank statement, and then you keep both of it and you see if there are differences, and if there are differences, where are the differences coming from, right? So timing differences. Uh, it is just a time gap in recording the transactions relating to either payments or receipts, just a time gap. You have recorded it in one place, but it has not yet been reflected in the other place. So we look at examples. Now, checks issued by the bank but not yet presented for payment. What essentially happens then? You as a business are issuing checks. Immediately in your cash book, you are going to make that as a payment, right? That is going to be a payment. Checks are issued, meaning money has gone out. But in your bank account, has the money gone out? Not necessarily. Only when the person to whom you have given the check or the business to whom you have given the check presents the check at the bank, and then the money will get um, reduced from your bank account. But that has already been reduced from the cash book, right? Do you understand? So when a check has been issued by the firm to another party, could be a supplier, it could be a creditor, but the other person has not yet presented it for payment, there will be a difference. And this difference will only be for a few days. The moment the other person presents the check in the bank, and the money gets deducted from the account, both the cash book and the passbook will have the same balance. That's the first thing. Now, checks paid into bank but not yet collected. When firm receives check, they are immediately recorded in the debit side of the cash book, right? When you receive a check, when a business receives a check, we are going to be like, yes, we got money, increase in cash book. But we have to realize this check. That is, we have to present it to our bank and money has to come to our bank account. That might take time. That is another time when there is going to be a timing difference. Direct debits made by the bank on behalf of customers. For example, um, if there is any amount that the bank is going to deduct on behalf of the customer. Examples are given, incidental charges, check collection charges, interest on overdraft. Such deductions will be made by the bank directly on behalf of the customer. So what happens? Our cash book balance will be high because we are not yet aware that this has happened, but our bank passbook balance will be low because that deduction has been made. So I hope this is also clear that we have looked at three timing differences. Now, fourth one, amounts directly deposited in the bank account. What if a person, instead of giving us a check, has directly made a bank transfer to our bank account? So bank account balance is going to go up, but cash book remains there. The moment we come to know that someone has deposited money in a bank account, we will adjust it. So that timing difference is there. Now, what if there are interest and dividends collected by the bank? If you as a business have subscribed to shares and dividends are collected by the bank on your behalf, and you are not aware of it as yet. So what happens? The bank balance will go up, but the cash book balance will remain as such, right? So that becomes interest and dividends collected by the bank. Direct payments made by the bank on behalf of the customers. What if there are some bills like telephone bills, insurance premium, rent, taxes, all of these bills? The bank will directly, there's a standing instruction to the bank to pay it directly to the person concerned or the entity concerned. So bank will automatically deduct it. But when the bank deducts it, you will come to know of it later and then you will make the deduction in your books. So the bank balance will be lower than the cash book balance. And finally, checks deposited or bills discounted, dishonored. If a check deposited by the firm is dishonored, the business the Okay, if a check deposited by the firm is dishonored, the same is debited to customer's account by the bank. But this information will not be available to the firm immediately. It'll have a time lag after which you will be aware of the fact that that the bill discounted has been dishonored or the check deposited has been dishonored, right? Again, a time difference. Now, moving on to difference caused by error. Error can either be committed by the firm or error can be committed by the bank. We will not be looking much into that. Now we'll move on to preparation of bank reconciliation statement. Preparation can be taking place in two ways. One is when we adjust cash book and the other is after adjusting cash book. But in practice, BRS is prepared after adjusting the cash book balance. We'll be learning about that in later. So first we look at preparation of BRS without adjusting cash book balance. Right. We may have four different situations while preparing the bank reconciliation statement. We'll have a look at it. One, debit balance of cash book and passbook balance we have to find. Two, credit balance as per passbook and cash book balance we have to find. Three, credit balance as per cash book we have to find passbook balance. Four, debit balance as per passbook, we have to find cash book balance. Now, do you understand that a debit balance in cash book means it's a favorable balance, meaning money, the receipts are more than the payments. There is money in the account. So the same thing, debit balance in cash book will be a credit balance in passbook. the logic over here is, whose money is the bank keeping safe? Is it their own money? No, it is our money. So when asset is increasing, we debit. An asset is reducing, we credit. When liability is increasing, we credit. When liability is reducing, we debit. So with that logic, bank is keeping our money. Is our money bank's asset, or is our money bank's liability? The more money we give bank, is bank's asset increasing or is bank's liability increasing? If you have to think by that logic, the more money bank has, which belongs to us, their liability is increasing. They are liable to pay that much to us. So with that logic, it's like an advance that we are giving, not exactly an advance, but it's just like a money that we are giving, which belongs to us. We are just giving it to them for keeping it safe. So with that logic, when money increases in bank account, it is called a credit. If you have noticed, if you get messages in your phone, some so and so amount has been credited to your bank account, means money has come in. But if we see it in cash book terms, credit means money is going out. Credit balance of cash book will mean that it's an unfavorable balance, meaning it's an overdraft balance, meaning payments are more than receipts. Is that possible in a cash book situation? If you only have 500 rupees, you can't pay 750 rupees, right? That is not possible, but that is possible with a bank account. That is called an overdraft. So that's called an unfavorable balance. So what we are going to look at is, um, both these are favorable and both these are unfavorable. So I think I had told this before. We start with one balance and we reach the other balance. Now, dealing with favorable balance, whether or not we are now, there are four categories. We will use the same logic everywhere. Okay. It will differ a little bit between favorable and unfavorable, but otherwise we need not go through whatever is given over here. Let's start with illustration 1. Okay. Um, let's have a read. Okay, let's read the illustration. From the following particulars of Mr. Vinod, prepare bank reconciliation statement as on March 31st, 2017. So what is the first thing that we need to write? We need to write the title of our statement. So we will write bank reconciliation statement. This will be the only sum where I'll be writing this. But as students, I think you should be writing it. It's not I think, but you should be writing it for all of the questions so that you don't miss it out during your exam. So bank reconciliation statement of Mr. Vinod as on March 31st, 2016, bank balance as per cash book. So whatever is given, if bank balance as per cash book is given, write that. If bank balance as per passbook is given, write that. Whatever is the balance given, we start with that, right? Now, balance as per cash book. What is given? 50,000. So I had told initially that a few things we will add and a few things we will subtract. Now, before that, I missed out particulars because you're so used to just teaching. Okay, particulars. Bank balance as per, we will just use one column. We need not use both the columns. You can follow what's given in the text because it's the same, but otherwise we will just use one column, right? This is just an amount column. So this will be the amount column. And we will just use this. Balance. Just give me a second. Okay. Now, checks issued but not presented for payment rupees 6,000. Yes. Now, this is where I feel you should listen very carefully. This is where the technique, the hand method or the arrow method is going to come into picture. Now, checks are issued but not presented for payment. So, whatever it is that you start with, that will be your right hand. So, if you are starting with bank balance as per cash book, what are we using, cash book or passbook? Cash book. So, that will be your right hand. Your other hand will be the other book where we are going to end up with, right? Meaning if you're starting with cash book, it will be passbook. If you're starting with passbook, it will be cash book. Okay, in this question, we are starting with cash book. So your right hand is cash book, your left hand will be passbook. Now, this is the first step. You keep it in the same position. It will be equal. Now we'll adjust um, the hands and then come to know whether we should subtract or add. Now, let's read the second point. Checks issued but not presented for payment 6,000 rupees. We have to either add 6,000 or subtract 6,000. So, it is equal. Cash book, passbook equal. Checks when you issue, where is it reflected first? Is it reflected as a business? When you issue a check, where is it first reflected? Is it reflected in your cash book or your passbook? You're issuing it to some person, your supplier maybe, or your creditor. The creditor has not yet presented it in the bank. So your bank account balance, will it be more than your cash account balance or will it be less? Just take a moment and try to understand what I've asked. It will first reflect in your cash book. The moment you give the check to a person, you are going to be like, that is going to be a deduction from my cash book. I hope that's clear. But the bank will see that deduction only when the person to whom you have given it will go to the bank and deposit it and then get the money. So your cash book balance will be less than your passbook balance, right? Now, first you keep it equally, assign one book to each hand, right? Here it is cash book and passbook. Then, second thing is you adjust your passbook or you adjust your left hand. Okay, you adjust only your left hand. So, in this position, we are starting off equally. Now, what will happen? Is it equal in our passbook and cash book now? No. Where is it higher? In our back? That is passbook, because people, we have in our cash book, we have given the check, the balance has reduced, but the cash book balance is higher. But so ideally, we can either keep this like this, like, the cash book balance is going up, passbook remains there. But for uniformity's sake, we will just adjust the passbook. So you keep it up, you keep it a little up. Now you see, passbook balance is more than cash book. So first step is keeping it equal and assigning a book, cash book and passbook. Second step is adjusting your left hand in relation to your right hand. You either move it up or you move it down. Once you, in our case, we are going to move it up. Once you adjust it, you see, you just look at your hands, look at your right hand and see which direction your right hand should move to reach your left hand. In this case, your right hand should move up to reach left hand. If your right hand should move up, you will add. If your right hand should move less, you will subtract. So, with that logic, first we will write, add, and say checks issued but not presented and 6,000. Now, we will look at the third one. So what do we first do? Keep it equally. Starting hand will be, right hand will be the starting balance, that is cash book. Left hand will be the ending balance, passbook. Okay. Next, bank had directly collected dividend and credited to bank account, not entered in cash book. So which is high? Bank account is high or cash account is high? Bank account is high. So what do? We adjust the left hand. We keep it up and we keep this down. And if this is up and this is down, our cash book is still here, our passbook is here. Which direction should our right hand move to reach the left hand? Add. If you think about it, that's the same logic we are over here. Balance as per cash book 50,000 is the right hand. And balance as per passbook, the final answer is our left hand. We are just seeing whether we should add to reach there or subtract to reach there. If it was one entry, very clear. You just add or you subtract because multiple entries are there. All the additions we will add it first and all the subtractions we will subtract it later. Now, so again, that dividends collected by bank, we will add. What is the amount? 8,000. Yes. Bank charges were not entered in cash book. So what does that mean? Bank charges mean bank account balance is reducing or increasing? Reducing. So starting off with equal position, cash book, passbook. Bank charges, meaning bank balance is reducing. We have to move the left hand. Bank balance is reducing, not entered in cash book. Cash book balance is still high. Which direction should our right hand or cash book hand move? Down. So we will subtract it. So we will write less and write bank charges and write 400. Finally, checks was deposited but not collected by bank, meaning you received a check. Immediately, what do? Your cash book balance will go up. But is it collected by your bank? Is your bank balance high? No. So what do? We adjust our hands. We start off with the same position. We adjust our hands up and down. So in this case, bank balance will be less compared to your cash book balance because the moment you receive the check, the cash book balance is going to go up. Now you adjust it, then you keep your left hand stationary and see which direction your right hand should move. Should it move up or down? Down. It was check deposited, not collected, which is 6,000. So 6,400 we should deduct and 14,000 we should add. So 60 plus 14,000 will be 64,000. 64,000 minus 6,400 will be 57,600. What will this be called? Balance as per passbook. So I hope with this example, you have understood what bank reconciliation is. We'll be working out more sum. This is a favorable balance. If you look at my previous page, I told you favorable, it's the same logic. Unfavorable, it's the same logic. So if you get a cash book balance, you start with cash book balance, you assign right hand to cash book and left hand to passbook. Now, if this is start with, right hand will be this. So I hope you have understood. We'll meet in the next class.